There is a little known trick for buying versus selling stock options. And once you hear it, it will make a whole lot more sense. The difference between selling and buying and selling, it gets people confused sometimes, myself included. When I was beginning as a trader, I could never remember, what do I want the stock to do? What do I want the option contract to do in terms of go up, go down, decay, whatever the terminology may be? This is how you can remember. So starting things off with buying options, whether you're buying call options or buying put options, what you want to have happen is the contract price to go up. And I'm going to use this trusty little baseball here. It's going to act as our snowball because we don't have any snow on the ground right now recording this video. Shout out to the Toronto Blue Jays. This is the Stompers from St. Catharines, their farm team from back in the day. What you want to have happen when you're buying stock options, you want this contract. This is our options contract, the premium that you paid. This is the snowball. It starts out small, but when you were on the schoolyard with your friends and you guys made a snow fort back in the day, you went on a recess time to make the snowman build up bigger, and you went and rolled the snowball across the ground. What happened to it? It kept getting bigger and bigger and bigger and bigger. So in the beginning, when you're buying these stock options, again, calls or puts, you buy the snowball when it's small. So once you've rolled it across the playground and it's twice, 3 times, 4 times the size, that is the contract value that is, and the snowball is so much bigger, you can turn around and sell it to somebody else. For example, the first or second graders who think this is the biggest snowball they've ever seen in their life, when it's not actually, and it only costs you a little bit of premium up front to buy, and then effort for the stock moving is what rolled the snowball across the playground, which led to the contract value being bigger. The snowball gets bigger and bigger and bigger like this when you go to sell it. So you bought it when it was small, it built up some momentum and got bigger, and you sold it for profit when it got bigger. This is the same for calls or puts. The only difference being that when you have call options, you want the snowball to be going up and gaining size. When you're using puts, you want the snowball to be going down and still gaining size. When the stock goes up, you make that money, the snowball grows. When the stock goes down, you make that money and the snowball grows again when you're using puts. That is for the buying side. Now let's go over to the selling side, where it's all still water-based. We're not talking about snowballs anymore. We're changing up and going with ice cubes. So when we're selling options, whether it's calls or puts, the contract value and the price change acts the same way. We're going to use ice cubes in this example to illustrate the purpose. I'm going to pop some of these bad boys out. Here's our contract value, okay? When you are selling options, you start out with this as your contract. This is the value of the contract. You get paid that up front. What you want to have happen as this ice cube melts in my hand, that is exactly what you want to have in your account for your trading. The quicker that this ice actually melts in my hand, the more money you get to keep overall. And what you can think of it as is this. You have this ice cube, this ice block, and you're going to say, okay, I have this towel now. What I want to do is put the ice in the towel, and everything that ice melts into the towel is the money that you get to keep. You initially sell the option, yes, but if you have to close out your trade early, you normally have to give some of that back. So you're selling the ice cube at the beginning right here. This is the contract value, and the contract value you want to get smaller and smaller and smaller and smaller. And if the stock price, if you're selling puts, goes up, this is going to happen very quickly. If you're selling calls and the price goes down for the stock, this is going to happen very quickly. But the more that this ice cube melts into this tablecloth, the more profit you get to keep overall in your account. You don't have to give any back. Because if you were to open this trade one day, the ice cube melted a little bit and you would close your trade off, you make a little bit of profit. But the more that this melts and the more that it soaks into this cloth, that's your trading account soaking up more and more profits that you don't have to give back once the trade goes to expiration. That's how it works with selling puts, selling calls. So you're thinking about snowballs right here when you're looking to buy, making the snowball bigger and selling it for a profit when it does get bigger. And when you're using the ice cube method, you want the ice cubes to melt and that option value to melt into your account, which is the towel. The more that it melts into your account, the more profit you get to keep and maximize your gains overall. So we got snowballs and ice cubes. And this one weird trick really helped me out when I was starting to trade and understand the concept of both, what you want to have happen when you're buying, what you want to have happen when you're selling. If you want to know more concepts like this, make sure you check out my Options Academy online course, currently offered at a 50% discount for all new traders. I will put the link in the description of this video. Thank you so much for watching. I'll catch you on the next one.